expect the balance sheet to shrink considerably more rapidly than in the previous recovery.
I think 50 basis points is going to be an option.
Remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression.
This is Bloomberg Surveillance, Early Edition with Francine Lacqua.
Well, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua in London, and this is what's coming up on today's program. Brainard the Hawk, the Fed governor, backs a speedy reduction in the central bank's balance sheet. Global bonds are sent tumbling. Zelensky tells the UN that Russia's abusing its veto powers. The U.S. and its allies will announce fresh sanctions on Moscow. And stay with Bloomberg Surveillance Early Edition. This hour, a little bit later, we'll have an in-depth conversation about energy markets and commodities with Jeff Currie from Goldman Sachs on our very own Javier Blas. You can send in your questions and analysis on IB Plus TV Go. You can also tweet me directly. Now, this is a picture for the markets. So we've seen a pretty brisk move when it comes to a lot of these bonds and stocks, given what we heard from Lael Brainard. The European stock 600 down some 0.9%. Again, a lot of the stocks are wavering on the prospect, as we were just saying about the Fed's debt holdings being reduced earlier than expected. And this would be, of course, part of a wider stepping up of a campaign of monetary tightening to tackle high inflation. So you see a repricing on some of the bonds. Again, when do they start being attractive enough so that we also see a rotation away from European stocks into bonds? Currently, the U.S. 10-year yield at 2.6069, and that U.S. dollar index, Bloomberg one 202. Now, if you delve a little bit deeper into the various European indices, now, of course, if you're the UK and the FTSE, you are extremely commodity rich. We did see a bounce back yesterday as commodities on the way up because of oil. Today, they're down some 0.4%. Bigger loss, for example, for the DAX, that's down 1.1%. Now, ahead of the FOMC minutes being released later this week, Lael Brainard said the Fed will start reducing its $9 trillion balance sheet at a rapid pace as soon as next month.
Given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Now we're joined by Nigel Bolton, Co-Chief Investment Officer at BlackRock Fundamental Equities. Nigel, thank you so much for joining us. I don't know whether there's, a repricing on the stock market because we didn't think about, of course, the balance sheet as much as we thought in terms of a tool for readjusting, or whether there's simply a fact that now the market thinks that the Fed is very, very aggressive in dealing with inflation, almost at the expense of growth.
Well, we always thought that this year was going to be a challenging year for equity markets. We thought there was going to be more volatility. History shows us that as we go into these periods, where we're moving into a tightening phase, that the market has to adjust. And that's indeed what we've been seeing. You then throw into that a war in Ukraine, and you've got all the recipes there for really quite a significant correction in markets. And I think that's what we've really seen over the last couple of months or so, where the markets have been adjusting to that. We had more news overnight from Brainard in terms of maybe the speed and the scope of the tightening. And this is a problem for investors globally, because we are in kind of slightly uncharted waters here. We haven't really been at this phase where we're getting to the proper tightening, the removal properly of QE, moving into that QT phase. Yes, we've always had rate cycles in the past, but this is an extra problem that investors are having to grapple with. So from our perspective, certainly from an equity markets, we're very much looking for resilience, companies that are resilient to this type of environment. And I think the growing risk as we move towards 2023 and into 24 of a recession. It's something that we talked about at the beginning of the year. The probability of that has risen, and that's what you're starting to see now impacting risk assets around the world.
Okay, so first of all, what kind of recession, and what does that mean for capital? I know you think capital is at risk. What does it mean for investment strategy then?
So I think what you have to really go towards quality. That is companies that have got strong balance sheets, companies that actually have got good business models that can prosper and do well in a more volatile environment. And I think the extra complication when we talk about recession is, are we talking about a GDP, a real GDP recession, or are we talking about a nominal GDP recession? I think the chances of a real GDP recession have significantly increased, but actually nominal GDP is likely to remain quite positive because this inflationary pressure that we've seen coming through is likely to last for longer. And that means there are going to be some winners as well as losers in the equity market. So you're going to get some real differentiation. Who can actually win in that higher inflation environment, even in the face of a kind of a real GDP recession?
And so, which means what? Are you adding to quality growth? Is it value stocks, or are you looking for just cheap things?
So look, I think you have to be more diversified than the last few years where it's been very much about growth. I think you want to avoid high-rated stocks. You want to avoid those where the value is based on a lot of future growth, because that is going to become more uncertain. So companies that can deliver you earnings, cash flow, and dividends today and have the ability to grow that. So which sectors are we thinking about here? I think the energy sector looks really interesting. I think the fundamentals have changed there, both in terms of renewables, but also in terms of more traditional energy markets. I think if you look at the industrial sector, historically, you might say not an area you want to go into in terms of a recession, but actually within that, there are a lot of winners going on there, particularly when you look at the sustainability here within Europe, the move towards reducing energy costs. So companies involved in insulation, companies involved in heat pumps, for example, those type of businesses are actually going to do well in this environment.
Yeah, I mean, on energy, there's a million questions on first of all, if you invest now, and I know we've gone back to fossil fuels, but by the time there's investment in there, of course, as a market participant, we could be at the end of the phase of fossil fuels. So there's always a problem of timeline. And of course, when it comes to renewables, we're extremely dependent on some of the raw materials going in Ukraine that are needed, that maybe the market is discounting, that are needed to make up for the transition. So how will this all play out?
You're absolutely right. And these are the complications. It's why you have to be very specific about the stocks that you're actually going to be investing in this environment. You have to understand their supply chains. Yes, there are definitely areas where the supply chain has been disrupted because of Ukraine. Now, markets, and businesses will flex and will find new sources. So it's understanding those companies that can win in that environment where there are disruptions to supply chains. Understanding the company's business model is going to be really important going forward.
Nigel, when you look at some of the quality companies, do you worry about the next earnings season, that actually there's something uglier happening there?
I do worry about the next earnings season. I think as we look at expectations for consensus earnings this year, it's about 9.5% for global. It's about 8% here in Europe. I do think that those numbers are going to come down this year. It's why you need to be finding companies that are going to be more resilient, that actually are going to be able to cope with supply chain disruptions, cost price inflation, and being able to maintain some growth within there as well. So I suspect that 9% global EPS number is probably going to be coming down more into the kind of 5 region as we get towards the Q4 this year.
Nigel, thanks so much. Nigel Bolton, their co-chief investment officer at BlackRock Fundamental Equities, joining us this morning. Now, Esther George says a half-point rate hike might be an option at the Fed's May meeting. The Kansas City Fed president also said that current economic conditions support removing monetary accommodation at a faster pace than previous cycles. Well, George spoke exclusively to Bloomberg's Michael Mickey.
We've got short-term policy rates, and we have a very large balance sheet that are affecting the amount of accommodation in the economy. So it will take thinking about both of those things, I think, as we come to our May meeting, to decide what is the appropriate pace, what's the appropriate amount of a policy decision at that meeting.
Well, there are a lot of people on Wall Street who say the Fed's behind the curve, and you've got to go 50 because you're going to lose control of inflation if you don't.
So we know that this policy is as accommodative as at any time when we have inflation this high, when we have labor markets this tight. So there's no question that policy has to be removed. But I think you have to do that in the context of having highly negative real rates, a $9 trillion balance sheet, and thinking about how that combination is going to flow through to the economy. So yes, we have to be very deliberate and intentional as we remove this accommodation.
Well, let me rephrase the first question. Would you support 50 if that's what the majority wants to do?
I think 50 basis points is going to be an option that we'll have to consider along with other things. And again, I'm very focused on thinking about how the balance sheet moves in conjunction with policy rate increases.
Well, let's talk about that. Lael Brainard, who's in line to be vice chair of the Fed, said this morning that she expects the balance sheet to shrink more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps. Does that summarize where the Fed is going?
So I think when you compare this cycle to where we were the last time, we were reducing the balance sheet, and we didn't go very far because of the need for reserves and the decision around that. When you look today at where the balance sheet is and the conditions in which we'll be doing that, I think it easily argues for going faster and moving along at a quicker pace than we did before. We have a ways to go to get this accommodation out of the economy.
Monthly caps of $100 billion sound realistic?
So I think we're still talking about what the right approach would be relative to last time. And again, we're doing that in the context of looking at the size of the balance sheet and the conditions in the economy today, which will likely warrant doing more and going faster than before.
What's your anticipated impact of reducing the balance sheet in terms of a rough equivalent to basis points in a rate move?
So I think it's an important question because we often focus so much on the benefits going in terms of how it pulls duration out of the market, it boosts asset values. I've been looking at some of the estimates that go all the way to 150 basis points effect of that balance sheet on longer term rates. So wherever that is, I think there is clearly going to be some adjustment that takes place, both in asset markets as well as long-term rates. And I think when I look at the yield curve, I'm looking at that issue relative to that balance sheet and what effect it's having on longer-term rates, less so around some of the conversation on whether it's predicting a recession.
Well, that was the Kansas Fed President Esther George speaking exclusively to our Michael McKee. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we'll also have an in-depth conversation about energy markets and commodities with Jeff Currie from Goldman Sachs and our very own Javier Blas. Send in your questions on IB Plus TV Go. This is Bloomberg.
Either remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression, its own war, and then do everything that we can do to establish peace.
That's the Ukrainian President Volodymyr Zelensky speaking at the UN yesterday. Now let's get the latest on the war in Ukraine. The US, the EU and the G7 are coordinating on a fresh round of sanctions on Moscow following the discovery of civilian murders in Ukrainian towns. So joining us now is Bloomberg's Europe correspondent Maria Tadeo. Maria, good morning. So what is this actually in the sanctions package and what concrete impact, if any, will it have?
Well, Francine, they're hoping that this will really turn on the heat on the Russian industry, but also in particular when you look at hydrocarbons. This is really the moneymaker for the Russian Federation at this point. And there is a realization, particularly here in Europe, that in many ways, if you strip away the jargon, we are sending money to Russia. And all of this is, of course, paying for that war machine that has unleashed or has been unleashed on Ukraine. Now, today we are expecting, as you said, the fifth package to be approved by European officials. We know that it will target coal buyers. Will have 3 months to pull out of these contracts. They won't be allowed to sign new ones. But the biggest question mark is what happens with oil, that is seen as a moneymaker, and gas, which is also seen as a geopolitical weapon of Vladimir Putin when it comes to blackmail. Today, we did hear from two very senior European officials, the head of the Commission, but also the head of the European Council, say it openly. There will be a debate around oil. And then when it comes to cashing those payments to the Russian Federation, Francine, there's also increasing debate about setting up something that looks like an escrow account so that Europe has more money and more power over where the funding is going and what the funding is used for. But again, all of this is still early days and certainly won't be approved today.
Maria, President Zelensky accusing Russia of committing unspeakable atrocities. In this context, how can peace talks between the two countries continue?
Yeah, and Francine, they were supposed to continue. We were expecting actually a video conference this week, but yesterday you heard from President Zelensky. He was furious at the United Nations, saying there is no point being here if you don't kick Russia out. Russia, in the same time, same place, continued to deny everything, saying the pictures are fake. This is an Anglo-Saxon media campaign. But for the time being, those talks allegedly would continue. But Francine, when you look at the situation on the ground, we know the fighting continues. We know the Ukrainian army is now preparing itself for a major offensive in the Donbass. And of course, we've seen that we're nowhere near a ceasefire.
All right, our Maria Tadeo there in Brussels for us. Thank you so much for joining us. Now, Smart Conversations continue on Bloomberg Surveillance Early Edition. Later this hour, we'll also have an in-depth conversation about energy markets, oil and commodities with Jeff Currie from Goldman Sachs and our very own opinion columnist, Javier Blas. You can send in your questions on IB plus TV Go. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, NATO foreign ministers are meeting in Brussels. That's as the US and EU are considering a new round of sanctions to punish the Kremlin over its alleged actions in Ukraine. Meanwhile, opinion polls in France, a key EU, G7 and NATO ally, suggest a close race in Sunday's presidential polls. So there is definitely a lot to talk about. We're joined by Lindsay Newman from S&P Global. Lindsay, thank you for joining us. I have a lot of questions first about the sanctions, the extra sanctions that the US is putting in place and the EU. If the idea is actually trying to deter Vladimir Putin from continuing its campaign of fear in Ukraine and killing civilians, it hasn't dented him at all. So what will work, if anything?
Well, what we've seen so far, as you say, is there's been a whole host of sanctions imposed across individuals, banks, financial institutions, and then, of course, a wave of corporate self-sanctioning that follow those steps by the U.S. and Europe and their allies. They've been effective in isolating Russia from the global economy. They've been effective in changing the sort of economic picture for Russia. So we are, in fact, forecasting an 11% contraction for Russian GDP for this year alone, and a further 4% contraction for 2023. Again, this is all from a self-created crisis by invading Ukraine on 24 Feb. But where they haven't been as effective, as you say, is actually halting what we're seeing on the ground in Ukraine. And in fact, as President Zelensky very clearly stated yesterday before the UN, there is, this massive humanitarian toll that we're seeing, these potential allegations of potential war crime activities that's being investigated. We did see overnight the U.S. took action to block Russian access to dollars held in U.S. banks to prevent them using that for bond payments. And that's something we've been watching, how Russia has been servicing its debt, but its ability to continue to avoid defaults in the longer term.
So, Lindsay, we just have a brilliant opinion piece by our Javier Blas saying, look, it's entitled Europe's hypocritical gas policy is not sustainable. And he argues in this piece that the EU cannot keep funding Russia's war by paying for energy supplies. If there was to be a full oil and gas embargo from Europe to Russia, does it change the course of the war?
So that is exactly what's being contemplated today. As we've already heard earlier in the program, for the first time, the EU is considering putting a ban on coal, as well as other energy assets or other energy supply coming from Russia. And in fact, we see President Macron even coming out and joining public calls for these bans on coal and even other energy supplies as he faces this critical election this weekend. But should this happen, we know this is a massive source of income that's sustaining Russia's ability for the war efforts, as well as for, as I've already said, servicing the debt. So it has the potential to be a game changer, but we will have to watch and see if this actually does go ahead and how comprehensively it goes ahead.
Lindsay, give us a sense of exactly what the next step is in this war and what it means for the European economy. Are governments rich enough to be able to put fiscal policies in place to shield, the people from a rising cost of living that makes the situation unsustainable?
Well, as you say, we're about 6 weeks into this conflict, and what we're seeing in the conflict itself is two key shifts that I would highlight. The first is around aim and objective, and the second one is around timeline. And these play into your questions because, as National Security Advisor Jake Sullivan said yesterday, we are seeing a shift in Russian objective, a shift in Russian aim here. They're pulling out of Kiev. The focus really is on the south and east with redeployments for the Donbass region. We think, though, that we're going to continue to see activities like the aerial bombardments we saw overnight into central Ukraine, where the target there is really these key infrastructure components like oil depots that were hit overnight, like food supply sources. And we have to remember that Ukraine and Russia separately are, while they make up a small component of the global world economy, for Russia, it's something like 1.8%, and for 1.1%, and for Ukraine, it's under 1%.
Right.
They actually are huge suppliers to these two European markets, as well as far afield with China and elsewhere in the Middle East, of key commodities like food supplies, grain, corn, fertilizer, and minerals. So that's going to hit home for all of these European economies.
Lindsay, thanks so much. Lindsay Newman, Director of Economics and Country Risk at S&P Global. Smart Conversations continue right here on Bloomberg Surveillance Early Edition. Up next, we'll have an in-depth conversation about energy markets and commodities with Jeffrey Currie from Goldman Sachs and our very own opinion columnist, Javier Blas. You can send in your questions on IB Plus TV Go. This is Bloomberg. Brainard, the hawk, the Fed governor backs a speedy reduction in the central bank's balance sheet. Global bonds are sent tumbling. Zelensky tells the UN Russia is abusing its veto powers. The U.S. and its allies will announce fresh sanctions on Moscow. And coming up next, an in-depth conversation from energy markets and commodities with our Jeff Currie from Goldman Sachs and our very own Javier Blas from Bloomberg Opinion. You can send in your questions on IB Plus TV Go. Now, good morning, everyone, and welcome to Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. This is the picture for the markets. Quite a lot going on in the markets, both on the stock side, but also on the bonds. If you look at a gauge of global bonds dropping below this key fixed income watermark after the Fed governor, Lael Brainard, signaled a quicker than expected rundown of the central bank's debt holdings. Now, I can see the picture for the S&P futures also down some 0.4%. Of course, the picture is what this means for anything in terms of earnings, in terms of inventories going forward. Stocks sinking after we heard that hawkish Fed. Now, the U.S., European Union and the G7 are coordinating on a fresh round of sanctions on Moscow. This would include an EU ban on coal imports following the discovery of civilian murders in Ukrainian towns abandoned by retreating Russian forces. Our European Council President Charles Michel also told MEPs this morning that the EU must impose those sanctions on Moscow in the near future.
The new package includes a ban on coal import. I think that measures on oil and even gas will also be needed sooner or later.
Let's get straight to Jeff Currie, Global Head of Commodities at Goldman Sachs. Jeff, thank you for making the time to come on Bloomberg. I have, first of all, a million questions about an oil embargo. If tomorrow, in 3 weeks, there's an oil embargo between Russia and Europe, what happens?
Obviously, it'd make prices go up. Why? Because you have to redistribute oil around the world. So you're going to get a bid in local barrels, particularly in the Western Hemisphere, and obviously Brent barrels, West African barrels to try to replace those Russian barrels. But the question then becomes, what happens to the Russian barrels? They get traded at a steep discount. We'll likely see if somebody like the Indians or the Chinese pick it up. But I think the key point here that people seem to forget is you need the Middle East and OPEC to agree to this, because you're going to basically have to crowd out their market share in places like China and India to replace those barrels in Europe, which I think will be a tall order to ask. So it's not easy.
But Jeff, so first of all, we know that there have been conversations, I guess, behind closed doors. How likely is it that this happens? How likely is it that we can deal with an oil embargo, even if the weather in Europe is not that good?
I think it'd be very difficult, which is why, they started with coal. Coal is the easiest. You can think about it on a scale of fungibility. Coal is the most fungible, gas is the least fungible, oil is somewhere in between. Coal is the one you just put it on ships, move it around the world, and it's relatively easy to reshuffle or redistribute around the world. Oil becomes a lot more difficult because it's more sophisticated pipelines, refineries, and things of that nature. And then gas is, I would say pretty close to impossible to do, which means gas would be the very last energy that they would potentially boycott. But oil, it'll be very, very difficult to do as well. So we'll see what happens. I think, they've already showed their hand, which is why they chose coal to begin with, because it's the most fungible.
Jeff, you have retreated a little bit on the oil price forecast since the strategic releases. Where are you now? And again, do you see the wider commodity complex under a lot more pressure than we have seen in the past?
Absolutely. We're still bullish on oil post the SPR announcement. We see oil trading up to $125 a barrel. I want to emphasize that what this ultimately does is it crowds out more investment. It makes this long-term situation worse because SPR release is not a long-term solution to underinvestment. As we like to emphasize, it's not about the supply and demand of the barrels of oil or metric tons of copper. It's about the supply and demand of the dollars used to produce those barrels of oil or metric tons of copper. And that's where the shortage is. Whether if it's ESG policies around the world creating a huge capital deficit or bank lending leverage ratios that is restricting bank lending credit to the industry. Let's think about this. Oil prices are 2 times higher than what they were a year ago. That means working capital requirements are 2 times higher.
Jeff, I also need to bring this to your attention. So traders are now betting on the Fed raising interest rates 225 basis points by the end of the year. This is after Lael Brainard, of course, sounded a lot more hawkish. The linkage between this dollar and oil is also very clear. Our Javier Blas from Bloomberg Opinion just sat down. Jeff, I annoy you and him almost every day trying to figure out what happens next with the price of oil. And one thing that I was chatting with Javier, and I'll bring him in a second, is how easy is it to actually divert some of the supply? So you're Russia, you're thinking, right, either there's an oil embargo from the European side or I'm going to do it. What kind of negotiations are ongoing? Because the pipelines are not necessarily there to divert all of this stuff to India and other countries east.
Extremely difficult to divert. Not only do you run into transportation issues, also long-term contracts of existing flow of oil to refineries around the world. But also the quality really matters. You just can't take any oil anywhere in the world and shove it into a refinery. There's light oil, there's heavy oil, there's sour oil, there's sweet oil. All of that really matters. So it's a very difficult time, expensive, and it's definitely not frictionless process.
All right, we'll have plenty more, of course, on the price of oil and other commodities. Jeff Currie, Global Head of Commodities at Goldman Sachs. Up next, also Bloomberg Opinion's Javier Blas gracing the floor. I haven't seen him for a while, so I'm also excited to speak to him here in the studio. Now let's get straight to the Bloomberg First Word News. Here's Leanne Gerrits. Hi, Leanne.
Hi, Francine. China's services sector took a massive knock in March. The Caixin Services PMI tumbled to 42 in March from just above 50 in February, the lowest level since the depths of the initial lockdown in early 2020. The reading was well below the 49.7 estimated by economists. The latest holiday spending figures suggest there's more damage to come this month. Now, the US, UK and Australia say they're working on developing hypersonic weapons as part of their trilateral security pact, AUKUS. The partners will also look to deepen defense cooperation in areas such as electronic warfare and artificial intelligence. Hypersonic weapons technology has already been deployed by Russia in Ukraine. And London's investment banks are struggling to shrink the gender pay gap, with women making up less than a fifth of the top earners. According to the latest UK government data, just 15.5% of the top quarter of earners were female across a sample of 10 securities units in the City of London, up only slightly from the previous year. That proportion is worse than the 20.5 across broader finance industries. Global News 24 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg. Francine.
Leanne, thanks so much. A little bit later on, we'll speak to Olivier Blanchard, the former IMF chief economist. That's at 8:45 a.m. New York time, 1:45 p.m. UK. But coming up, an interesting, important conversation with Jeff Currie of Goldman Sachs and Javier Blas. We'll talk oil, commodities. Maybe we'll also get a question or two about nickel. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now we're back with Jeff Currie, Global Head of Commodities at Goldman Sachs, and Bloomberg Opinion's Javier Blas also joins us. Now this morning, Javier has also written a column entitled "Europe's Hypocritical Gas Policy is Not Sustainable." In it, he argues that the EU cannot keep funding Russia's war by paying for energy supplies. Jeff Currie also has a wonderful new note out talking about a financially constrained physical market. So thank you both for either sticking around or joining us. First of all, Javier, when it comes to supply, I mean, I know you're baffled at the price of oil. Talk to us a little bit about the dynamics that means that you think it should be higher.
I'm surprised that we are only at $110. I know that there are some factors that they are pushing prices down, including the release of the strategic petroleum reserves that Jeff was mentioning earlier. But if you look at the physical market, we are facing a shortage. And the market itself is shorter than it looks like because some of the Russian oil is flowing into the market. The traders are fulfilling the long-term contracts. They're buying that crude. But that crude is not going to any refinery. In a market that is extremely short, in a market that is massively backwardated, in a market that every barrel should be consumed, we are putting Russian barrels into a storage because no one wants to buy. And that at one point, we are going to just have to go higher.
Yeah, and Jeff, this is also, someone's writing in, a viewer, thank you so much for all of the viewer comments, but, this person wrote at length, basically saying, where is the supply constraint? If you look at Venezuela oil, if you look at, Iran will be soon back on the markets, if you look at some of the other things, like, is there a supply problem right now for oil?
Absolutely, yes. And this goes back to 2014. Overall CapEx is down 35%, yet demand is higher. If you look at every producer, with the exception of UAE and Saudi Arabia, are producing less today than they were in January 2020. So when we think about these supply constraints, they're broad-based. In particular, you think about non-core OPEC, places in Africa like Angola or Nigeria, because it's deep water offshore platforms and the concerns around decarbonization, we've seen no money go into those parts of the oil complex. And as a result, the supply constraints are severe. Throw on the Russian shock on top of it. The supply constraints are, the biggest we have seen in decades, since the 1970s. So no, this is a real shortage. Hence why the Americans just, had a record SPR release that is still insufficient to be able to deal with the scale of the problem.
And this is despite, Javier, China also being in semi-lockdown. So how do you model an oil embargo and the impact? Like, what are the flows to and from Russia and into Europe?
Well, Russia exports about 8 million barrels a day of crude and refined products. If we lose a significant chunk of that, at some point we are gonna lose that. There is no replacement. China and India can buy a fraction of that, but they will hit logistical limits that Jeff was talking about. I mean, there are so many tankers that you could use. There is no extra pipeline capacity into China. There is no pipeline capacity into India. There's simply not pipeline. Everything has to be done by tanker. So we will suffer a significant reduction in supply, and on a market that is already very tight and with very limited inventories to start with. This is not a comfortable situation that we started with. We started with a market that it was tight or very tight, and we are going in a massively tight market. And one very important thing, we are just emerging from the lowest point of the year in terms of oil demand. Yes. Traditionally, the end of March, beginning of April, is when all the refineries are doing seasonal maintenance to prepare for the summer demand. From here all the way to the middle of August is incremental demand. And we are already $110 and we are struggling to supply the market. What is going to happen in June and July when all of us are going on holiday?
But Jeff, that's a floodgate for stockpiles, right, to be released. I mean, we keep on hearing Fatih Birol, they have the stockpiles. I mean, how much can they help in supporting this?
Well, I think when you look at where they are, and the big stockpiles are in the U.S. So the question is, who's going to request to take those barrels out of storage? We'll find out. The release they did back in November, only a third of the barrels were actually taken because they actually, ultimately they're a swap. They're going to be bought back at some other point in time by the U.S. government. And I think the key point is the logistics to get those barrels to the refineries that can process them. It's kind of that same problem we were talking about before, is not all oil is created equally, nor are all refineries created equally. And the one thing we haven't talked about yet this morning really is what's going on the product side. Products are extremely tight. That's where the shortage is. It's developed, particularly jet fuel and distillate right now.
There's also, that's an extremely good point. We also have another viewer, Javier, saying, Russian oil exports are de facto under sanctions. So what would be the real impact on Russian oil exports if Europe were to sanction its oil? Gas, of course, being another story.
Well, there is self-sanctioning, but some of that oil is still flowing. We have not seen yet a significant reduction in Russian oil exports. We have seen some reduction, but not a significant one. So if real sanctions were put there, we can lose half of the production of Russia. That will create a 4 million barrel a day hole into the market that it will be very difficult to replace. And to the Jeff's point, Russia not only export crude, they export a lot of refined product and semi-refined product that we need, and that's potentially the biggest problem. Diesel and jet fuel are in short supply. Jet fuel earlier this week went up to the equivalent of more than $300 per barrel in New York Harbor. That is what supplies all the New York airports. That is much, much higher than it went in 2008. So that's a big, big problem.
Jeff, what part of the commodity complex do you most worry about? So in this brilliant note that you put out, you talk about a financially constrained physical market. I mean, we talk, almost day in, day out about a possible big margin call. Like, is something in the commodity complex going to go wrong? And if so, could it happen quite quickly?
The one that is in the worst shape in terms of tight fundamentals are the grains. The shock coming out of Ukraine on wheat. 25% of the world's exports. You're unlikely going to get the planting season in Ukraine this year, which will leave you really tight going into the new crop next year. So that's the one that's potentially the most explosive, and also it's the one that has the biggest impact on potential social civil unrest in places, particularly like North Africa. But beyond that, oil is the one we're watching. I think I agree with Javier. It's startling that oil is only trading $110 a barrel right now, given the fundamental backdrop. And it's the one that's being the most severely impacted by this underinvestment, as well as liquidity issues.
Jeff is right, highlighting food, because that is where potentially is the biggest political implication. Energy matters. Energy is important for the industry, but food prices in emerging countries, North Africa, West Africa, Southeast Asia, the only thing that is keeping those areas from serious civil unrest is that the fact that the price of rice remains under control. It has not gone up as much as wheat and other ones, but vegetable oil, we are going to face shortages. I mean, in many countries already in Europe, you go to the supermarket and you cannot buy more than X number of bottles of vegetable oil, particularly sunflower oil. That is going to come, and it's going to become more widespread as the months go. We're going to have all to go to default to olive oil, Francine.
I mean, being Italian, I'm not against it, but we did have the Colonel chief executive yesterday, and they, of course, make, I think, 50%. Ukraine makes 50% of global sunflower oil, and they're the biggest producer there, and the picture is not very good. Going to nickel, I know we've been writing about nickel nonstop. Jeff, when you look at the nickel market, and frankly, the nickel chaos, does that put, the London Metal Exchange at risk of what it can do? Like, how much pressure is it putting on the LME?
Well, I mean, there was specific issues tied to this in the sense that you had groups that were basically long the Shanghai exchange and short the LME, and there was, you basically had limits on how fast the Shanghai could go up. and you basically created a margin call on the LME that couldn't be met from profits out of the Shanghai. So let's take that out. But it illustrates a much bigger problem here, which is the access to liquidity. It's not isolated to metals or nickel. You think this goes to this point. Look how high commodity prices are today versus where they were, a year ago, 2x. And as a result, the overall capital needed to fund these positions is far greater, and the access to that capital is not there due to, Dodd-Frank type of regulations going back, nearly a decade ago that restrict leverage of banks, that do not allow the increase in capital that's sufficient enough to meet this. So this is a serious problem, and it's not isolated to nickel or the LME.
So this doesn't put the LME more in a spotlight than other. I mean, it does, but it doesn't put its future at risk.
It definitely puts the LME more in the spotlight. But I think the key point here, and this happens at every bull market I've ever been through, is what happens is as the prices go higher and higher and higher, the producers who have sold forward get hit with margin calls. They buy back those positions that drives the market higher and higher as you go through this dynamic. But what's making this one far worse than anything I've ever seen before in creating a volatility trap is that the lack of liquidity. The lack of liquidity forces either more buying, more selling, which then drives up the higher volatility that then discourages more liquidity. The banks don't want to give any funding to this market with that type of volatility. Neither do investors. I like to say the market may be long on conviction, but it's short on position due to these financial constraints.
All right, thank you both for joining us. A very robust conversation. Jeff Currie, their Global Head of Commodities at Goldman Sachs, joining us, and also thanks to Javier Blas from Bloomberg Opinion. Now, coming up, Elon Musk joins Twitter's board. We dive into the details of this move and what it means for social media companies in general. This is Bloomberg. Economics, finance, politics. This is Bloomberg Surveillance Early Edition. I'm Francine Lacqua here in London. Now, Twitter has named Elon Musk to its board. Everyone's talking about this. This comes a day after it was disclosed that Musk is Twitter's biggest shareholder. Well, joining us now is Bloomberg's Quick Takes, Alex Webb, who, of course, is in charge of all of our technology coverage. Now, first of all, Alex, I mean, this is an amazing story. Why is Elon Musk getting, what exactly is he getting for his money? How much influence will he have on the company, and how big of a financial commitment is it?
So for him, it's not a massive financial commitment. Right. It's probably about $2.5 billion is how much it costs to get this 9.2% stake, whatever it is. That's less than 1% of his net worth. Now, what he's getting for it, influence. If you look at the way that Twitter's been affected over the past 2 years by its activist investor, Elliott Advisors, which is Paul Singer's activist fund. They had less than half of Elon's stake. They got a board seat. Within 18 months, 2 years, the CEO, Jack Dorsey, was out the door. So, Elon could possibly have looked at that and gone, for not a huge amount of capital on my part, I can get a huge amount of influence over a company that is, for me, super important. Because if you look in Tesla's SEC filings, it says in those, Elon's ability to generate earned media is really important to us.
Yeah, so I was going to say, I mean, is this like a financial investment? Is this like, in the context of Tesla, is this, about money, or is this like you and I going to, I don't know, sewing and buying a PlayStation?
I mean, I think it's better to think about it in terms of billionaires buying newspapers, right? When they buy newspapers, they're not necessarily doing it to make money out of it, but it is an influence play. Now, we don't know for sure. Guessing exactly what Elon's up to is a bit of a mug's game. But he has the ability here to control his voice, in a sense.
Well, there you go. This is another meme request for Elon Musk to come and speak to Bloomberg Surveillance Early Edition. Alex Webb, thank you from Bloomberg. Quick Take. Bloomberg Surveillance Early Edition continues in the next hour. Matt Miller, Kailey Leinz in New York, Guy Johnson here in London. We'll have a full roundup of what we heard from Fed Governor Lael Brainard. This is Bloomberg.
The Fed now has to come out guns blazing.
Concerned that the Fed is going to keep hiking.
It does appear as if the central bank is willing to sacrifice growth.
I expect the balance sheet to shrink considerably more rapidly than in the previous recovery.
I think 50 basis points is going to be an option.
This is Bloomberg Surveillance Early Edition with Anna Edwards, Matt Miller, and Kailey Leinz.
It's 10 a.m. in London, it's 5 a.m. in New York, it is 5 p.m. in Hong Kong on this Wednesday, April the 6th. These are our top stories. Ahead of today's FOMC minutes, traders are now pricing in 225 basis points of hikes from the Fed this year. On top of that, as we just heard, Lael Brainard is warning of an aggressive unwinding of the balance sheet. After the atrocities in Bucha, Russia will likely be hit with fresh sanctions today. We'll be live in Brussels with the latest. And JetBlue shocks the aviation world with a $3.6 billion bid for Spirit Airlines that could unseat a deal already agreed with Frontier. Welcome to Bloomberg Surveillance Early Edition. I'm Guy Johnson in London with Matt Miller and Kailey Leinz in New York. Anna Edwards is off today. Kailey, let's talk about the markets. Hong Kong reopening, really interesting Asian session.
Yeah, and it was a risk-off sentiment that dominated the Asian session, Guy. As you said, Hong Kong opened back up from a holiday. You had Hong Kong lower, you had Japan lower. Put it all together, and the MSCI Asia Pacific Index was off by about 1.4%. This really is a market digesting those hawkish words from Lael Brainard and awaiting the FOMC minutes later on today. Now, of course, that rippling through the bond market as well, and in a big way. That global bond sell-off definitely evident in the Asia Pacific region. You had the two-year yield in New Zealand up 19 basis points. That is a 4 standard deviation move. And at 3.17%, that is the highest for that yield going back to 2015. You also had the 10-year yield in Australia touching the highest since 2015. It ended the day about 8 basis points higher, 2.93%. This is obviously a bond market, Matt, that is preparing for more hawkish central banks, not just here in the U.S., but across the world.
Yeah, absolutely. And we have very high yields here in the U.S. as well, or at least the highest since 2019. Take a look at S&P futures, right now down 0.33%. That after a drop of 1.33% yesterday, because those higher yields are spooking tech investors and pushing the NASDAQ down. And of course, the S&P 500 is so tech heavy as well. The 10-year yield continues to climb as investors let go of that debt. 2.6163%. No longer inverted in terms of the 2s and 10s. We came out of that inversion yesterday, but the 10-year yield continues to rise as the Fed comes out more hawkish. Yesterday, Brainard, George, and Daly all saying inflation is the #1 enemy here. NYMEX crude, speaking of inflation, up another 1.2% today, still around 103 a barrel. Yesterday when we saw it, it was around 105, almost 106 at this time. It then came down throughout the day and is back up now. 103.21 is your quote for Texas Intermediate. And Bitcoin, the same story. Yesterday we saw it around 45, 46,000. It had gone up, and now it's come back down from midnight. That's what we quote here. So it's down 1% from midnight to 45,386. Still a relatively high level, but maybe a little bit of a risk-off signal. Guy, what are you seeing in terms of European markets?
Well, let's talk about the equities. It's a sea of red, Matt. That's the picture, as you can see here. London outperforming a little bit. Commodities doing a bit better. DAX is down by 1%, just over 1%. CAC down by around 1%. Let's look at what is happening cross-asset right now as well to get an idea of what is going on. Equities really not at the center of the action. It is a bond market story front and center around the world, as we've been hearing. Stock 600, therefore, down by 0.9%. Bunds are selling off once again. Actually, I would argue the real pressure is in the periphery. Remember, PEP has ended. The ECB goes into a quiet period tonight. Deutsche Bank has a very aggressive call on rate hikes from the ECB. Euro dollar below 109, below 110, 109, but actually a little bid this morning. Brent crude, as we've just been hearing on the oil markets, 107, nearly 108. We are up by around 1%. But keep an eye on what is happening with coal. That is the story. Coal yesterday rising rapidly. Today, we are expecting further sanctions, Kailey, to be coming out when it comes to Russia. Let's take a look at those Russian assets. The equity market is bid this morning. The ruble continues to be sort of fairly flat. It remains surprising how well it's bid. But to be honest, I'm not sure that's a clearing price, as Damien Sassa continues to point out. Anthony Blinken talking about the idea that it should be under further pressure. Maybe sanctions do that and continue to edge away at what is happening there. That's the picture with Russia right now. But the sanctions story, Kailey, is going to be front and center today. And the pressure just keeps getting ratcheted higher and higher.
Absolutely, Guy. We'll be looking for those sanction headlines all day today. And what else are we looking for in the day ahead? NATO foreign ministers are meeting in Brussels as the U.S. and allies coordinate on those new sanctions on Russia we have just been discussing. You also will have the U.S. FDA advisory panel meeting to discuss the use of future COVID-19 booster shots. At 10:30 a.m. New York time, oil executives are set to testify on gasoline prices at a House hearing on Capitol Hill. And finally, the big one. The Fed minutes are due at 2 p.m. New York time. Matt.
All right, the Fed is stepping up its tightening rhetoric. Yesterday was pretty amazing. Governor Lyle Brainerd says the central bank will raise interest rates steadily while starting balance sheet reductions as soon as next month that will be accelerated compared to the last QT. Listen to what she said.
Given that the recovery has been considerably stronger and faster than in the previous cycle, I expect the balance sheet to shrink considerably more rapidly than in the previous recovery, with significantly larger caps and a much shorter period to phase in the maximum caps compared with 2017 to 19.
Let's get more with Bloomberg's Danny Berger. Of course, we also heard from Esther George and Mary Daly. So it looks like everybody is coming out very hawkish.
Yeah, they really are singing one note considerably more rapidly. Those two nearly back-to-back adverbs really spooking the market. And it makes sense that they did, because previously what we had heard of the balance sheet reduction came from Joe Powell saying that this time around it would follow a similar playbook to last recovery. Now the market needs to wrap their heads around a balance sheet reduction where the maximum cap is likely to be larger. Last time, the maximum was $50 billion per month. This time, estimates are anywhere from $80 billion up to $120 billion, more than double that figure coming from Inflation Insight and Omar Sharif over there. So what sort of knock-on effect will this have to markets? I was speaking with Jordan Rochester of Nomura earlier, who said that all we need is $100 billion, and that will upset markets. And look, I have a chart for us, for our radio listening audience, that often is considered a chart crime, so I'm going to tread carefully here. I'm looking at the Fed balance sheet and the S&P 500, both of them rising in tandem. Now, I don't want to imply that correlation is causation here, but many investors think that this is the main reason. Okay, but Matt, many investors think that this is the reason, that because the balance sheet has gone up, that the S&P 500 has gone up. So I'm not implying it, but enough people believe it that it could have a psychological effect at the very least. But for some like Deutsche Bank, it's not just psychological. They think that there will be a recession next year and that equity markets will tumble 20% into the summer of 23, Kailey.
All right, Bloomberg's Danny Berger, not implying anything, but informed reporting for us this morning. Now let's get to the latest on Ukraine. The U.S., EU, and G7 are preparing to impose more sanctions on Russia. This is following the discovery of civilian murders in Ukraine. Ukraine's President Volodymyr Zelensky urged the United Nations yesterday to do more to stop Moscow's aggression.
Either remove Russia as the aggressor and a source of the war so it cannot block decisions regarding its own aggression, its own war, and then do everything that we can do to establish peace.
Let's get more on the fresh round of sanctions with Anne-Marie Hordern, our Washington correspondent, and Maria Tadeo, our European correspondent. They're in D.C. and Brussels, respectively. Anne-Marie, let's start with you. What exactly are we expecting to hear from the Biden administration today?
It's really a lot of the more of the same in terms of the sanctions playbook that the United States has been going after. So you're going to see financial institutions, state-owned enterprises, also Russian government officials, as well as their family members. Now, the Wall Street Journal has a little bit more details on exactly what they're going to be targeting. Sberbank and Alpha Bank was mentioned in their report, as well as the United States, potentially what the EU may do as well, going after President Vladimir Putin's two daughters, Maria and Katerina, as well as from the United States, a ban on all new investment in Russia. We should also note that we're going to be hearing today from Treasury Secretary Janet Yellen. She's going to be speaking in the House, and this comes as we have these fresh new sanctions. And she's going to really warn about the economic repercussions that are going to be affected globally due to this war. And two issues she will highlight that we're going to really want to focus on is where Russia plays a very outsized role in the market. And of course, that's energy security as well as food insecurity.
Anne-Marie, thank you very much indeed. Anne-Marie in D.C. Really nice Khodorkovsky story there as well from Anne-Marie in D.C. Let's talk about what we're getting out of Brussels. Maria Tadeo standing by, our Europe correspondent. So are we going to get the coal sanctions today? Is anybody going to resist, or is this a done deal?
Well, Guy, if you ask me, this is now a done deal. And in fact, we have a lot of detail now from this fifth package of sanctions that the European Union will very much likely approve today. We know it's about 10 billion euros of Russian exports into the European Union will be blocked. Of course, the highlight measure from this is that ban on coal. And essentially the way it works is that buyers will be given 3 months to wind down their contracts. And after that, they won't be able to sign new ones. There will also be an export ban of European technology into Russia for about another 10 billion euros. So overall, this package is 20 billion euros. But Guy, in many ways, as I said, this is a done deal, and the conversation is now moving into what's next. And I hear already there's works around a sixth package, so a new one that would come into play here. And today, Ursula von der Leyen and the head of the European Council, they both said, ultimately, we're going to have to start looking at oil. And this is pressure that is also piling, particularly after those pictures came out of Bucha. But also, let's just remind ourselves that the invasion is going, so this is not going to be the last of it. The Europeans are preparing themselves to see more atrocities committed on Ukraine, and then, of course, the response to that. So oil is very much now up for debate.
It is incredible to watch the sequencing here. You do wonder whether that is being held back because of the expectation of worse still to come. Maria, thank you very much indeed. Bloomberg's Maria Tadeo, our Europe correspondent, joining us from Brussels. Let's turn to corporate news. JetBlue has offered to buy US budget carrier Spirit. The price tag $3.6 billion. That potentially spoils a competing bid, a lower bid by rival Frontier, and it could reshape the landscape for the ultra-low-cost air travel market in the United States. The domestic market is booming stateside. Sidharth Philip, Bloomberg Europe Airlines senior reporter, joining us now with more. What does Robin Hayes want with this deal? Why is he stepping in at the last minute, Robin being the CEO of JetBlue?
Absolutely. So for JetBlue, this would be an opportunity to get into the sort of top 5 carriers of the US. And given the fact that leisure travel and budget travel, that's basically the sector that's booming at the moment, with business travel and overseas travel pretty tepid at the moment. So Spirit Airlines would offer a great opportunity for JetBlue to actually consolidate its network, focus on leisure destinations in the US, and sort of expand from its main areas of New York and Boston.
Of course, Frontier wants Spirit too. What was their response to the JetBlue bid? Will they have to come in with a higher number?
So Frontier has been it wasn't very happy about JetBlue's bid. And they said that essentially it wouldn't be a good fit, and that their bid was far more attractive in terms of offering consumers better sort of value for money, and JetBlue would not really do that.
All right, Bloomberg's Sid Phillip in London, thank you so much. Both JetBlue and Spirit Airlines, we should mention, down about 2.5% in pre-market trading here in the U.S. And let's get a look at some other stocks moving in pre-market here in the States. I want to check, of course, on Twitter, up 30% in just the last 2 sessions on a rapidly unfolding series of events. First, news of Elon Musk's passive 9.2% stake. Then he gets a seat on the board. Then Twitter says, yes, we are testing an edit button. Then Musk refiles to say, actually, yes, I am having an active stake in this company. Twitter giving back a little bit of gains this morning, down about 1.3%. Also moving lower, Stellantis for a second day, really along with a lot of its automaking peers. The concern here is that more sanctions on Russia could lead to more supply chain issues, which, as we know, car companies already have been grappling with for some time. Stellantis down 3.3%. One car maker, EV maker, actually bucking that trend is Rivian. Reported first quarter production numbers after the bell yesterday. Actually was able to deliver a little over 2,500 vehicles despite those supply chain issues. So getting a little lift in the pre-market guy, up about 1.7%.
Kailey, great stuff. The Ukrainian President Zelensky, speaking to the Irish Parliament right now, the Dáil, making comments talking about the fact that Russia hasn't abandoned its plans to occupy all of Ukraine, making that point forcefully. If we get any more headlines, we will bring them to you. Matt, let's talk about what is happening with the markets. We need to dig in to what is going on in the bond market. We're going to do that in just a moment. Peter Schaffrik's going to be joining us, global macro strategist at RBC Capital Markets. We're also going to discuss fresh sanctions on Russia. Julie Norman, UCL lecturer in politics and international relations, joining us a little bit later. Plus, going full manga, David McCormick, who once championed diversity and inclusion under Ray Dalio, is now trying to out-Trump Dr. Oz in Pennsylvania, in the Pennsylvania race that could become one of the most expensive Senate primaries ever seen. You're going to read more on that story, actually, on today's Big Take. All you got to do for that, go to your terminal, NI Big Take. You'll find that fantastic story. This is Bloomberg.
Welcome back to Bloomberg Surveillance. We are simulcast on both Bloomberg Radio and on Bloomberg Television. I'm Matt Miller with Kailey Leinz here in New York. Guy Johnson out in London. Anna Edwards is off this week. I'm looking at value versus growth because we've heard this narrative that there's a rotation into value from growth. We kind of hear that at the beginning of every year, and it doesn't seem to pan out. Again, it's not happening the way you might think that it is, even as Treasury yields rise. We saw 260 today, and typically higher yields mean pain for tech stocks. Ksenia Galuchko joins us, Bloomberg Equities editor, to talk about why this is happening, what we're seeing. I mean, indeed today, Ksenia, we're seeing tech stocks take a hit, but you're not seeing the rotation that you may have thought we would. Why?
Yes, it's been a fascinating period. So going into this year, everyone expected value stocks to outperform massively because of the rising bond yields. But they only had a few weeks of outperformance, and growth stocks, and especially U.S. tech, has been extremely strong. And the reason behind that is that investors generally tend to prefer big U.S. tech. They see that as the most profitable sector. They see it as being able to overcome any inflationary concerns, pass on the higher costs of products to the consumers. And that's why the NASDAQ, for example, has rallied about 14% since hitting a bear market in February. So this has been a pretty impressive outperformance. But again, like you said, today tech is under pressure after the hawkish Fed comments.
Bear market rally, is that how we should think about what we've seen over the last few days from the tech sector?
Absolutely, yes. So Morgan Stanley's Michael Wilson has been a big proponent of that theory. He says we should sell this bear market rally, that it will not continue, that it is very dangerous, and that the correction in U.S. stocks, especially tech, will continue. At the same time, the majority of strategists out there on Wall Street are still very bullish on the U.S. stock market generally. And they say that gains, although much more muted compared to the previous 2 years, will continue despite the hawkish Fed, despite higher inflation, and despite all the other concerns like war and economic growth slowdown.
Ksenia, great stuff. Thank you very much indeed. Ksenia Galuchko on what is happening in these markets. Of course, for more market analysis, check out MLIV, Markets Live, on your Bloomberg terminal. This is Bloomberg.
This is Bloomberg Surveillance Early Edition. I'm Kailey Leinz with Matt Miller in New York and Guy Johnson in London. Anna Edwards is off this week. Now, keeping you up to date with news from around the world, here's the first word. China reported more than 20,000 new cases of coronavirus Tuesday. The increase was driven by surging infections in Shanghai, where authorities are building the world's largest makeshift isolation facility. A convention center is being converted to house more than 40,000 patients. Bank of America plans to bring all of its U.S. employees back to the office by June 1st. That includes those who haven't been vaccinated against the coronavirus. B of A employees will still have some flexibility to work from home, but they are being strongly encouraged to collaborate with colleagues in person. The European Union's foreign policy chief called a summit with China's President Xi Jinping a, quote, deaf dialogue. Josep Borrell said China didn't want to discuss the war in Ukraine. That casts doubt on how much cooperation Beijing will offer to end the fighting. And an ex-oligarch says that from Vladimir Putin's perspective, Russia is already at war with the U.S. and its Western allies. Mikhail Khodorkovsky said that was once Russia's richest person. The exiled oil mogul told Bloomberg that because of sanctions and arms shipments to Ukraine, Putin views Russia as fighting the West on Ukrainian soil. And Matt, this raises a question, and you pointed out this is one of our top read stories on the Bloomberg terminal today. When the West talks about not wanting to escalate the conflict any further, maybe it's already escalated to one party, Vladimir Putin.
Yeah, I thought it was an amazing story. Anne-Marie Horton has been covering Khodorkovsky from the beginning, so great job on her part there. On the other hand, Khodorkovsky hasn't talked to Putin in 18 years. Putin put him in a gulag, guy, for like a decade, right? So they're not huge fans of each other. Maybe you need to take his comments with a grain of salt.
But it's interesting because he is briefing European officials and he is briefing officials in D.C. as well. So his point of view is going to be heard. And this is really going to come down to what NATO wants to do next. If this is effectively a proxy war in which NATO is already involved, how is that going to ultimately impact what comes after sanctions? because we're reaching the limits of sanctions, right? We're getting to the end of what is going to be possible. And in theory...
we haven't applied the one main sanction that we should yet, right?
We haven't. We haven't, but it feels like it's being sequenced, doesn't it? As the bad news comes out, we're getting tranche by tranche worse and worse sanctions from a Russian point of view. After that, like if you believe you're Clausewitz, you go into the military sphere. That potentially could be what comes next. Anyway, we're going to discuss the rates story next. We're going to focus back on the Fed. Peter Schaffrik, global macro strategist at RBC, is going to be joining us next. That is what is coming up. This is Bloomberg. This is Bloomberg Surveillance Early Edition, and here's what you need to know. Ahead of today's FOMC minutes, traders are now pricing in 225 basis points of hikes from the Fed this year. On top of that, Lael Brainard is warning of an aggressive unwinding of the balance sheet. After the alleged atrocities in Bucha, Russia will likely be hit with fresh sanctions today. Penalties will be increased on financial institutions and state-owned enterprises, plus sanctions will be placed on unspecified Russian officials and their families. And what do we need to know about JetBlue? JetBlue shocking the aviation world. It has put through a $3.6 billion bid for Spirit Airlines that would unseat a deal already agreed with Frontier. Spirit is apparently evaluating the offer. I'm Guy Johnson in London. Kailey Leinz and Matt Miller are in New York. Anna Edwards is off today. Matt, what's happening in U.S. markets ahead of the open?
Well, Lael Brainard is really what's happening still today. After yesterday, we saw the S&P down 1 1/3%. A client writes into me that called her commentary the bearish shot heard round the world. S&P futures are down 0.5% again after she said the Fed could unwind the balance sheet at a faster pace than it did last time. Remember, last time we got to $4 trillion and barely came down to 3.5 before we shot up to 9 again. So they should certainly be able to do that. The 10-year yield up again, 2.6144%. So we're no longer inverted. That's higher than the 2-year by a decent amount, a substantial amount, and I think about 6 basis points. And that's the highest we've seen since 2019. So these yields climbing, as Ksenia Galuchko was telling us, that's no good for techs. NASDAQ futures are down as well. Crude oil right now up 1.2% at 103.20. That's for Texas Intermediate. And Bitcoin is down 1.3%. Again, it's highly correlated with stocks. So when you see stocks down, Bitcoin is down as well, but still holding at $45,277. Kailey, what are you seeing in terms of pre-market movers?
Well, I want to take a look at the action for JetBlue and Spirit. As Guy mentioned, JetBlue making that $3.6 billion bid for Spirit, knocking out potentially rival Frontier, who had already made a lower bid for that low-cost carrier. JetBlue really trying to get a firmer footing in the budget market in the U.S. But after that news, which of course broke about half an hour before the close of trading yesterday, JetBlue is down about 3.5%. And after a 22% jump in the final 30 minutes of trading yesterday, we are seeing Spirit retracing some of that down about 2.7%. Also moving lower is Tesla. Of course, this is a large cap, technology-oriented company, very, very high multiple. So it's being put under pressure by higher rates. 1.9% decline for that stock in early hours. And a little bit of a decline for Twitter as well after a 30% gain in 2 days on a series of events unfolding related to Elon Musk's active stake now in the company. That stock is softer by just about 0.9% before the bell, Guy.
Absolutely. We're 2 hours into trading here in Europe. Let's talk about where we are with our markets right now. Stock 600 continuing to track lower. We're down by around 1%. Car stocks are down today. Luxury stocks are tracking lower as well. Think about the fact that we're going to be seeing Russian families being sanctioned. That could certainly be a factor into that story. BTPs, the Italian bond market, continues to remain under pressure. Spreads are widening. Quarter periphery. Pay attention to that. The ECB certainly will be. It goes into its quiet period this evening ahead of the next meeting. Euro-dollar is actually bid, but again, that bid is starting to fade. We're still south of 109.13, and that is the coal trade. We're up by another 6.48% on European coal today. It rose yesterday. The expectation is, as we were hearing from Maria a little bit earlier on, that we will see sanctions being applied to Russian coal as of today. Yeah. Let's talk about the Russian assets, Matt, and just get a quick idea of what is happening here. This is the picture. Actually, the stock market is reasonably well bid today. The ruble is coming back a little bit, but it's absolutely flat to my mind. I think it's a real struggle to try and understand exactly how we price this right now. The market is swinging all over the place, but there's so much stuff going on under the surface in terms of the support that's being applied. And again, similar sort of story, Matt, for the bond market right now. I'm not sure how real these markets are.
Can I just point out a couple of things I want to quickly point out, Guy?
Yeah, okay.
One is that...
I got that impression.
The one is that European governments are paying Putin for his gas. They say they're paying in euros, but they're exchanging those euros for rubles at his bank at his exchange rate. So that's certainly helpful in terms of getting the ruble back to where it was pre-war. Also, coal is something they want to get away from anyway. And they really only import that much coal from Russia because they're trying to phase out their own, as you are in the UK as well, I'm sure, their own coal mining industry. So this isn't the most difficult sanction. This is the problem, right? The most difficult sanction, the one that really would hurt Putin and that would cut off funding for his war effort, is if they would stop buying oil and gas. And this is the one that they're not doing.
Matt,
all right.
but that's where we are. That's the sequencing story right now. You get Bucha, you get coal. What do you? The pictures coming out of Mariupol could be potentially even worse.
Yeah.
Is that when you step up to that next level? I don't know, but certainly that's what people are talking about right now here in Europe.
Yeah, and we'll see what happens in Mariupol if that forces Scholz's hand to take bolder action. I want to give you quick breaking news on what's going on in Hong Kong. Yesterday we were talking about Carrie Lam saying that she won't run for a new term and speculating about who could fill her seat. Now we see her number two, John Lee, right now speaking live, saying that he will seek that post. So he is going to talk to Beijing, if he hasn't already, and look to fill her position when she well, she's got to run for re-election. She's not going to run for re-election, so ostensibly he'll run for election. Of course, these things are carefully planned by the Central Committee. More now on the Fed as officials step up their rhetoric on tightening. Kansas City Fed President Esther George spoke yesterday exclusively to Bloomberg's Michael McKee.
When you look today at where the balance sheet is and the conditions in which we'll be doing that, I think it easily argues for going faster and moving along at a quicker pace than we did before. We have a ways to go to get this accommodation out of the economy.
Peter Schaffrik, global macro strategist at RBC Capital Markets, joins us now. And Peter, you know, to me, the most interesting thing is not only how hawkish they have all become, and they're singing from the same hymnal, I think someone said earlier, but that they're talking about going up to the neutral rate, and Esther George said they may even need to go through it. Historically, when that happens, it sends the U.S. economy into a recession. Is that your base case scenario?
Well, first of all, I think you're absolutely right. I mean, it's a very crucial step to go through neutral, wherever neutral exactly is. And one of the things that we are expecting is that the economy will start slowing down. Whether we hit a recession is a different story, but it's definitely in the second half of the year. We already, and pretty much everyone had already expected a slowdown anyway, and that's most likely going to be exacerbated by the rate hikes that we're going to see.
But will an eventual slowdown actually start to slow the pace of the Fed's rate hikes? Do you think they're credible when they say they can move at each and every meeting this year if they start to see a deterioration in the data in the back half?
Yeah, what we are expecting is for the next two meetings, we're going to see 50 basis point steps. That seems to be, as one of my clients said it, nailed on. And thereafter, actually, we do think that they're going to slow things down a bit, that they're only going in 25 basis point increments. We see that lasting for the entirety of this year and into early next year, and we'll have to see what's happening thereafter. I mean, if we're right and if the economy starts to slow, it's probably going to last not much longer than this year.
So what does that mean for the bond market, Peter? We already see a 10-year Treasury yield at 2.6%, the 2-year just about 6 basis points below that. How much more legs do you think the bond sell-off has?
Yeah, I think the interesting thing is when you look at what the forwards are currently pricing in the front end of the curve, we're not far away from what the dot plots are telling us. So unless sort of we get another significant shift higher, which is possible in the early phases of the 50 basis point hikes, and where we're not really sort of seeing the slowdown effects of the economy coming through, we could probably push a little bit higher. But towards the second half of the year, we actually think that this is going to peter out. So we're probably not too far away from the peak in bond yields. We're probably not quite there yet, but again, the forwards are higher than spot.
Peter, what is aggressive QT? The kind of aggressive QT that Leo Brainard is talking about, worth in basis points. Can you give me your calculation?
Yeah, I mean, first of all, I actually can't give you sort of the rule of thumb because it's very, very difficult how much that's worth. And we're probably priced in a much more aggressive path of QT already. And, I mean, Powell has indicated that we're probably going to learn something from the minute. That's why everyone's watching it. But when you sort of look what's the likely range here, we reckon that we're probably going to see a cap on reinvestments that's going to be much higher on treasuries than where it was before. Let's call it 60 billion a month. And that's probably going to be, apart from the refunding month, that's probably going to be higher than what's coming due anyway. So we're going to see a relatively quick pace here. But again, I think in terms of what it means for the market, we've probably priced in a lot of that scenario already.
Peter, let's talk about what's happening with the ECB. Going into a quiet period this evening, Deutsche out with a really interesting note overnight. With Eurozone inflation likely to be sustained at 2% or more, we see the ECB raising rates by 250 basis points between this September and next December. Peter, what do you think about that call? Do you think it's too aggressive? How hard will the ECB have to go?
Well, first of all, I'm totally on board that the ECB will have to do something. And I'll come back to the magnitude in a second. But I mean, one of the things that's absolutely key for me is what the ECB has always had as their defense is that the inflation expectations in Europe have been very low. And obviously coming out of a period where disinflation was the current concern rather than inflation, that was a mighty argument. But when you look at it now, that's not the case anymore. On spot, on forward, 5-year, no matter what you look at, the inflation expectations are in part significantly above the target. So that's no excuse anymore. So, the only other sort of excuse that the ECB can waive is that wages haven't been really going up, but that's probably just a question of time. So the ECB will have to do something, and they've indicated and they've turned bearish, and that's very clear. As regards the magnitude, in my mind, it's a similar question as you just asked me for the US. We're probably going to see a slowdown eventually anyway, particularly if the US slows down. And if that's the case, then probably the magnitude that the ECB can deliver is maybe not going to pan out as much as you just indicated.
Peter, one of the beauties of I just moved back to the US last month, and one of the main benefits is I can buy a Porsche here for a lot cheaper than I can buy a Porsche in Stuttgart, where they're actually made. Part of that has to do with the amazing amount of taxes that Europeans are willing to suffer. But the other part is the exchange rate. We've been stuck at 109, 110, it feels like for a while now. Is that to the benefit of the European economy? Does the ECB think about that when making policy decisions?
Well, as the ECB always says, is one part of their consideration, but it's not a policy tool. And I think that's probably truer now than it has been in the past. But because when you look at it now, I mean, one of the issues that we currently have is obviously sort of the externally induced prices. So whereas previously the ECB was always concerned that the euro is too strong, I don't think that this is their concern at the moment. If anything, then probably to the contrast. But I mean, I actually think that the domestic economy is in a much, much better shape now. I mean, we'll have to see once everything is said and done with the war impact and the second round effects, how strong it is then. But compared to the previous, the domestic economy is much, much stronger, which means that the external sector is less important than it used to be. And therefore, I think the exchange rate itself is probably less relevant than it was in the past.
All right, Peter Schaffrik of RBC Capital Markets, have to leave it there, but thank you so much for your time this morning. Now, we are getting some breaking headlines out of the Russian finance ministry. Russia saying that a foreign bank has rejected a $649.2 million Eurobond payments. They're commenting on the 2022 and 2042 Eurobond payments. Russia saying they transferred those payments in rubles to NSD. That is Russia's national settlement depository, a really key component of Russian financial infrastructure, but really just speaks to the difficulty Russia is going to have staying current on its debt obligations, especially in light of the action taken by the U.S. Treasury yesterday to not allow payment through U.S. accounts. And this is, of course, as we're expecting more tightening and more sanctions announced from both the U.S. and the EU today. We'll discuss those fresh sanctions on Russia with Julie Norman, UCL lecturer in politics and international relations, coming up next. This is Bloomberg. This is Bloomberg Surveillance Early Edition. You're looking live at the principal room. Coming up later today, Dr. Anthony Fauci, National Institute of Allergy and Infectious Diseases Director. That's at 1 p.m. in New York, 6 p.m. in London. This is Bloomberg.
They shot everyone they saw, one witness said about Putin's soldiers. This, honorable members, is what is happening when Putin's soldiers occupy Ukraine territory. They call it liberation. No, we call it war crimes, and we really have to give it this name.
European Commission President Ursula von der Leyen addressing Parliament earlier today in Brussels. NATO foreign ministers are meeting in Brussels today as well. The US and allies coordinating a new round of sanctions on Russia. Joining us now for more analysis on this, Julie Norman, UCL lecturer of politics and international relations and co-director of the Center on US Politics. Good morning. So we're getting sanctions, and these sanctions appear related to the atrocities, the alleged atrocities that we've seen in Bucha. My question is, what comes next after this? Are we basically in a sequencing process as the news out of Ukraine gets worse and worse and worse, so the sanctions story will be ratcheted up and up and up? When we get to Mariupol, are we going to be in a position where we're going to be sanctioning Russian oil and gas?
Well, we certainly are seeing a certain kind of cycle emerge, and certainly after the atrocities that were reported over the weekend, both the U.S. and EU and NATO are likely to impose new sanctions today. From the U.S., that is likely to include a ban on all new investment in Russia. This, of course, comes off the back of the Treasury announcing a halt on any U.S. dollars from U.S. banks to pay Russian debt. And from the EU and NATO today, we're expecting to hear more of a focus on potential sanctions on coal imports from Russia, which is a bit of a hit at the energy market, but not nearly as substantial as, say, oil or gas would be. So
Yeah, but Julie, even if Europe does get to the point where they actually take action on energy, what powder does that leave still in the keg? Are we going to get to the point where there's nothing else left to sanction, and what does that leave the West with?
Well, that's certainly one of the difficult moments right now, is trying to figure out what to do beyond sanctions, because the sanctions can have some effects. Obviously, we're seeing a contracting of the Russian economy, but so far has not really seemed to shift Putin's approach to this war or pushed him any closer to a withdrawal or a ceasefire. So the sanctions, of course, are always coupled with, again, the military aid. The U.S. announced $100 million further of javelins yesterday to continue with the anti-tank and anti-armor weaponry. But in terms of what else the West can do, unfortunately, their hands have been somewhat tied from the beginning with the sanctions and military aid because of the commitment, and many think rightly so, from NATO not to get directly engaged in the conflict for risk of further escalation.
I wonder about the ruble bouncing back. It does seem as though European payments for oil and gas are not only helping to support the Russian economy, fund the war, but also have stabilized the ruble now because they're exchanging that at Putin's exchange rate. Is that a concern at all? Is that something that EU leaders are trying to keep a little bit quieter?
Oh, it's certainly a major concern. And again, Putin played that very strategically in terms of trying to push the payments for energy in rubles. There was a bit of a kind of standoff last week with the EU trying to figure out how to be able to negotiate that and work with that. Again, all of this, I think, is leading into a larger discussion, of course, ongoing in the EU about how to wean off of this dependence on Russian energy. But we all know that's not going to be automatic. Right now, as you said, I think it's about, we've heard reportedly like $30 billion from Europe has been going to Russia just since the start of the war for energy alone. But again, that's very difficult to switch off overnight, especially with supplies like
Julie,
natural gas.
When you see the pictures out of Bucha, Julie, if, it's right now they're allegations, but if the Russians are just systematically executing civilians in Bucha, is that not worth taking the hit of shutting off gas from Russia automatically?
Certainly, and I think that's where the moral argument for this rightly is. Again, realistically, though, I think some European states are worried that the cost to them would be even more than the cost to Russia. Right now, Russia would still have other markets to export their oil and gas to. For European states, that would be taking a major risk, not only for quote unquote higher energy prices, which I think many are willing to absorb, but actually the risk of recession and kind of derailing their own economies and putting a worse hit on them than Russia would potentially get. So all of that is being weighed right now. And again, through all of this, you need to get the entire bloc on board with whatever decision is made. So many states are ready to make that move already. Other states are just becoming a bit more willing to discuss it.
And sanctions, to a certain extent, do have a domestic role. That's kind of sanctions 101. Maybe the idea is that you save some of this for later when the picture gets worse, because if you don't, then the next option, potentially, Julie, could be military action. Julie Norman, UCL lecturer of politics and international relations and co-director of the Center on US Politics. Thank you very much indeed. Coming up later this morning, Evelyn Farkas, former US Deputy Assistant Secretary of Defense for Russia, Ukraine and Eurasia. That conversation coming up 7:30 a.m. in New York, 12:30 p.m. in London. This is Bloomberg.